The broadcast is now starting. All attendees are in listen-only mode.
Hello, everyone. Welcome to the 2020 halftime report. We appreciate everyone taking the time to join us virtually, and hope everyone's doing well. Our goal is to keep it under an hour today, depending on your questions. And to let you know, if you do have a question, you can type it. There's a questions area in the meeting window, probably to the right of your screen. And I want to point out that you can see an orange arrow at the top left of that meeting tool. If you click that, it will minimize it and allow you to see our presentation in full screen. So if you do have a question, you just click it again. You can view the question area, send us those questions, and we'll address those at the end. So of course, you don't have to use this tool. If you have something afterwards, you're always feel free to give us a call or email us with any questions, and we'd be happy to get back to you on it. So here, we'll start off with these important regulatory disclosures. We know you guys love those. If you want a copy of it, we'll be happy to send you that as well. So we can get past that. And Brian, you want to get us started with today's agenda?
Yeah, we got a pretty full agenda today. I think it's safe to say that this COVID-19 pandemic has affected pretty much every American and most people around the world, for that matter. So we'll start with that. We'll provide a brief economic update, and then the governmental fiscal response and the central bank or monetary response to the situation, which has been massive. Dennis is going to cover a little bit about what's been happening in the markets year to date. We do have an election coming up, and it's just starting to heat up. So we've been receiving a few questions about that. So we'll hopefully give you some food for thought about the election and what, if anything, to do about that. And then we're going to cover our strategy going forward and some of the trades and moves that we've been making so far this year. So let's just go ahead and start off with COVID and the virus and what's happening. We're not obviously infectious disease specialists or medical doctors. We're financial advisors, but we do view, obviously we view this virus and the pandemic as the most important factor that is affecting our financial outlook over at least the near term, if not the long term. And, if you tune into the television or the internet, you get a lot of, perhaps one-sided, and a lot of blaming and should have done this and would have been better if we would have done that. And we have found a resource, and I think we've shared it with some of you, but Johns Hopkins University has put together this interactive map that is, we think, pretty unbiased, and it's very, very deep and robust. You can look at anything from, new cases. You can see down in the lower right-hand corner what's happening with the, the so-called flattening of the curve or the new cases. You can look at things as dark as death, or you can look at things as bright as recoveries. The fact is, a lot more people recover from the virus than die of the virus. So it gives you a good balanced look of really what's happening with, with COVID-19. If you can just move forward, Dennis, and I think that, it's, safe to say that the virus, look, it's not a matter of whether this is, we find ourselves in a good or a bad situation. I think we can all agree that it's a pretty difficult, it's bad. But really, from a financial perspective, or at least a markets perspective, the question is not whether, the situation is good or bad, because it's important to remember that the markets reflect the aggregate opinion of all market participants, and there's millions of very smart people on the buy and the sell side of every publicly traded security, stock or bond, around the world. Every single day, billions of dollars trade hands. So it's important to think of the market as a pretty efficient information processing machine, where all publicly available information instantly gets embedded in the prices of publicly traded securities. So I hate to bounce around, but Dennis, bounce back to that.
Okay.
Yeah. So when you go into the Johns Hopkins website and you see this and it's all red and, there's, almost 19 million confirmed cases, that's bad. But the question is it better or worse than expected? And with respect to the virus, if we see that things are coming along worse than expected, there's more cases, there's more deaths, or there's not as many recoveries, or, heat actually, makes the virus thrive rather than suppress it, or, people are not being careful enough with this new idea of social distancing, then we're likely to see stocks decline. I mean, we could test the March lows. We're not going to count that out. If, on the other hand, the news is bad, but it's better than expected, although people are still dying, and we recognize that, and it's a tough situation. But if the news is just a little bit better than expected, even if it's horrible, you can see markets increase, and perhaps increase dramatically, and we saw that in the second quarter. So the next slide is just our attempt to recognize that this is not just a financial crisis that we're dealing with, it's a health crisis. People are dying, and so we're not going to be able to really move past this from both a financial and a health perspective until we get widespread accurate testing, effective treatment, and an effective vaccine. And I think it's important to recognize that we do have infectious disease specialists working around the clock, around the world, medical doctors, chemists, lots of people at the pharmaceutical companies who are looking for all of these things, and whoever comes up with the fastest, most accurate test, or the most effective treatment, or the most effective and lowest cost vaccine. Here's the thing, these people are smart, and most of them are very good people, but importantly, there is a lot of money to be made by whoever finds these solutions to the virus. So there's a lot of progress being made on all these fronts. Obviously, we're not there yet. And until we get a meaningful combination of any of these, and or we develop herd immunity, which another term of art, like social distancing, I guess. Herd immunity, everybody probably knows what it is, but my 8th grader understanding of it is that you catch the virus and you develop antibodies to become immune to it. And until we develop herd immunity or we get an accurate vaccine, I think we need to be prepared for a start and stall economy, and therefore, we're not likely to be through this rough patch that we're in, and there can be lots of volatility ahead. That's not to say that we won't make money. We very well may, but it's we're in a tough situation, but we're up for the task. So
exactly.
Let's take a look at a little bit about what's going on in the economy, Dennis.
Okay. Yeah, so this is likely not a surprise to any of you, but we are in a recession. So on June 8th, the National Bureau of Economic Research reported that the U.S. entered a recession in February of this year. And I know this is kind of some economic jargon. So what is a recession? A recession is a significant decline in economic activity lasting at least 2 consecutive quarters in areas such as industrial production, employment, income, wholesale and retail sales. So, we're in that now, of course, and, the sharp declines in the stock markets we saw early this year happened before this announcement. As Brian just mentioned before, I mean, this is because markets are forward-looking, and the expectation of a recession was quickly priced in. And then when those expectations change that the recession may not be as severe as we first thought, we saw rapid increases in the markets. And secondly, on here, I mean, we all know COVID is a global concern as well. And you see on this chart on the right of the slide that more countries, this has caused more countries to simultaneously move into recession this year than we've seen during the World Wars or the Great Depression. So right now, 93% of the countries across the globe are in a recession. So, what does that mean? What do we do going forward? I mean, remember, we're already 6 months into this. And so, as we always do, let's look at the data. What's happened after previous recessions? We've been through these before. And so this slide just looks back at the 15 recessions we've had since 1926. And what the data shows is that in 11 of the 15 recessions, or 73% of them, that returns for stocks were positive 2 years after the recession began. And remember, we're already 6 to 7 months in. We're in this area right here. I don't know if you see my cursor or not on there, but it so we're already a quarter into that time frame. And on average, after this 2-year period, the average return was 8%, just slightly less than the long-term average of 10 for stocks. So what we see from this data is, one, that markets again and again show us they're extremely efficient, and almost instantly pricing in the news and expectations. And so it's, Brian kind of highlighted, but it's crucial to remember, I mean, if you know about it, unless it's something you have inside information on, and don't go trade on that because you don't want to end up in jail. But, if it's
That's 20 years, I think. So
so that's not worth making more money. But so if it's something you know about, and there are millions of other investors that have the same information you do, or the same fears you do, or the same expectations you do, and they're buying and selling stocks, throughout the day based on that information as well. And so knowing that, it's really just best to invest with what's the highest probability of successful outcomes. And this shows us that 3 out of the 4 times, if you stay invested, you'll see positive returns within the 2-year time frame. And remember, for any money you've told us you need within the next really 3 to 5 years, we have invested in cash and money markets and bonds, and so we don't have in stocks. And so which allows you not to be forced to sell in this short period of time, or not have to play the losing game of market timing when you get in and out, so that money is ready.
That's good. So as Dennis said, we usually try to keep these programs, very high level and very simple, and we try not to use jargon. But if you'll indulge me for a little bit, I am going to talk about monetary policy and fiscal policy, because it's been, it's been a huge stabilization factor or boost. I'm sorry, Dennis.
I would say it's important though right now.
It's really important, and there's a lot of misunderstanding about it and a lot of disagreement with it perhaps, but we're just going to kind of cover the facts and sort of tell you what's happened. I mean, again, we recognize that COVID-19 is the most important driver of our near-term, direction, or at least aligns near-term outlook. But the fiscal and monetary policy and the stimulus and low interest rates and what have you are probably second most important, at least as far as our near-term outlook. And what this slide or picture shows you is all of the fiscal stimulus, and here we're not talking about central banks. Here we're talking about governmental stimulus, like the new PPP loan program, and what it's showing you is with the green bars, that's the amount of fiscal stimulus that's been provided by not only the United States, but you can see this is a worldwide phenomena. Here's the US, here's Germany, here's Japan, here's Canada, so on and so forth. And it's pretty evident that the amount of governmental help or fiscal stimulus provided to help economies and help businesses and help people through this real difficult channel that we're in, the amount of governmental help has dwarfed, absolutely dwarfed the amount of governmental help, even though it was massive, that we saw in the crisis of 2008. You can see, let's just focus on US for this discussion, and that is, you can see the US amount of governmental help or stimulus is about triple what we saw in 2008. And I mean, I'm sure you've heard or you're watching television that the Republicans and Democrats are kicking around about another $1 trillion of governmental help or stimulus to help businesses keep employees on the payroll, help businesses pay their rent, help people pay their mortgages, so on and so forth. So it's massive. It's been not only massive, but it's been extremely rapid, and it's been kind of a globally synchronized phenomena. Now, one of the questions that has come up is who's going to pay for all this? I mean, this can't last. And look, don't shoot the messenger, but we think that, it's always best business policy to, tell it like it is. And here's the thing, as much as we hate income taxes, on the right, this chart here is a picture of income tax rates, the highest income tax rates, going back to the enactment of the Internal Revenue Code back in 1913, I think it was enacted. And what you see is that, we are enjoying some of the lowest income tax rates that we've ever seen. So, look, I think the writing's on the wall. The government is spending more money than it has since World War II. Someone's going to have to pay for it. It's going to be the taxpayer. These ultra low income tax rates are not likely to last, irrespective of who wins the White House. I think that we need to be prepared for higher taxes, and on the line we are gearing up, watching the tax environment very closely, and we think that tax planning is just going to become more and more important, and we're going to do everything in our power to keep your tax bills as low as possible. But I think we all need to be prepared for higher taxes going forward.
Right.
Move forward a little bit, Dennis. So the governmental help is one thing. The help that we've seen on the monetary stimulus standpoint from the central banks has been another huge driver, I think, of the incredible rebounds that we've seen in the second quarter and ongoing even this week. And this top chart shows that nearly every central bank, not just the Federal Reserve of the United States, nearly every central bank around the world has set its target rate at a record low level. I think it's like 88 or 89% of central banks are targeting the lowest interest rates that they've ever targeted in history. And not only that, this bottom chart shows that the last rate change that was instituted by central banks was a rate cut for like 100%, not quite, but I think 97% of central banks around the world, the last announcement or move that they made on interest rates was a rate cut. So this has brought up a question from a number of clients and people. Well, okay, so when are rates going to go back up again? When are rates going to rise? And we're not holding our breath. I mean, it's not often that we quote, the Federal Reserve Board. If you go to the next slide, Dennis, there's just, I don't see how Jay Powell, who's the Fed chair, could be any more clear. He says, and note the date, June 10, we're not thinking about raising rates. In fact, we're not even thinking about raising rates. So I think that we're going to be in a very low interest rate environment, at least for the foreseeable future. In fact, I hate to bring this home or pound this home, but the Fed rarely repeats what they say verbatim. But just 6 weeks later, I think that on the next slide, here's Jay Powell. There was a reporter that says, well, what if inflation gets out of hand, or when are you thinking about raising rates? And he said, I can't say it any better than I did back in June. We're not even thinking about raising rates, not even thinking about raising rates. So I thought that was interesting that he used the exact same language, some 5 or 6 weeks later. So I think that we are going to be stuck with low interest rates for a long period of time. So that's not a good thing for savers. That's not a good thing for CD buyers. Not necessarily a great thing for bond owners collecting interest payments. But listen, if I don't forget it, it is a good thing if you have any debt, particularly mortgage debt, that's more than, I don't know, maybe even like 2 years, 3 years old. I'd go back and look at that promissory note and look at the stated interest rates, because this is high time to be looking at refinancing. It could save you a bundle of money in interest. So. This all brings up the next question, and that is, well, okay, this is all fine and dandy. But okay, interest rates are zero. Rates can't go below zero, can they? Isn't the Fed out of ammunition? What else can they do if rates, if interest rates are already at zero? And again, I'm going to ask you to give me a little leeway here, because I think it's a little bit instructive or helpful to, in this case, use a little bit of lingo. You've heard the term, I think, at least on television, quantitative easing, and I'm going to try to explain that. It's been another big boost to the financial markets, particularly in the second quarter of 2020. Quantitative easing is just a methodology by which the Federal Reserve banks in the United States and around the world have been going out into the open marketplace and buying financial assets, in particular buying bonds. It's typically, treasuries or governmental bonds. But even in the United States, the Federal Reserve has been buying not just treasuries and governmental bonds, but they've been buying corporate bonds and even bond ETFs. So think about this. I want to try to keep it really simple. It's like economics 101. If you have any commodity, whether it's stocks or socks or bonds, okay? And you have a lot of new demand for that thing, whether it's socks or in this case it's bonds, and you have about the same supply, a lot of demand from a big buyer with very deep pockets, what happens to the price? Demand goes way up, supply is the same, price goes up, right? So that's what's happened in the financial markets. We saw that in the second quarter. And when the price of any financial asset goes up, at least any financial asset that pays interest or a dividend, or maybe you own rent houses, it pays rent. When the price of any financial asset goes up, its yield goes down. Interest rates go down. So, and the interesting thing about the Federal Reserve, banks around the world, they've got a very sophisticated technology called the printing press. So they can just flip the switch, print more money, go out in the open marketplace and buy more assets. So I don't think the Fed is anywhere near being out of ammunition. And they've made it really clear that they're gonna use all of their tools to help the economy get to the other side. It's in everyone's best interest that we get through this, and we will get through it. And at least some of this has shown up. Earnings have been really good with companies, which is really important, or with some companies anyway. But this Fed stimulus and this monetary stimulus has been very helpful. And Dennis, why don't you talk about what's happened in the market so far this year?
Okay. Wait till this comes up here. Okay, so the chart you see here is the global stock market over the past 12 months. And, as we know, things were looking really good as we closed out 2019. The U.S. had a 19% gain for the year. And then on February 19th, it was even better. The S&P 500 closed out at an all-time high. And then, of course, we had the COVID outbreak. And so we've got, things like, over here, the largest one-day point decline, in history. And then we see oil prices collapse. And please judge me on my job as a financial advisor, not as an artist. So I'll try to circle these the best I can. But so, these news, some, news along with it, COVID, things like that, caused the S&P 500 to plunge 34% over a month. So, this was the quickest bear market and bear market decline in history. And so, during this time, investors liquidated record amounts of stock. About $5 trillion went into money markets. And this is even more than we saw during the financial crisis. And so, at the end of June, sadly enough, that money's still sitting on the sidelines. So we've got a lot of money still sitting on the sidelines. And I'm just guessing these investors wanted to do what we've heard too many times, which are things like, I'm going to wait till things get better, or I'm going to wait till the economy improves, or I'm going to wait till the recession's over. Things like that. So again, we've said it before and we'll say it again, markets are forward looking, and it reminded us of that very quickly after this. For the March 23rd low, the U.S. market soared 40%, notching the best return ever. That's ever over a 50-day period immediately after. And so, look at the headlines from that point. Record rise in unemployment. We had a fourth of the economy goes idle. That's where the NBER said, okay, there was a recession after all. So all this news was why we're having the quickest return over 50 days we've ever seen. And so think about that investor waiting to get back into the market until we hear the recession's over. I mean, it was just announced that we were even in one after this. And so by the time the recession we're told the recession's over, what's going to happen between now and then? And you've already missed the boat more than likely. I'm not going to go. Let me get rid of my drawings here. So this
Keep going, Dennis. You're good at that.
So this is the first quarter, and as I just showed you, I mean, it was a really bad quarter for stocks. We all know that. But what I really wanted to point out on this is over here to the right, you'll see bonds did their job in that first quarter. This is why we own them. U.S. bonds were up over 3%. Global bonds are up about 0.5%. We're going to go over some. We've got some long-term bonds in your portfolio. They were up about 21%. That is some nice art right there, by the way. So 21% gain in
You're
those.
in the right job, Packard. You're not going to go into art.
I'm doing this with my right hand. I'm a lefty, so it makes it even harder.
Impressive.
So then quickly, things changed in the second quarter. This was actually, I was surprised to read this, not a while back, that this was the best quarter for U.S. stocks in 22 years. So with all this going on, and think about how we all felt that after that first quarter of this year. Who would have thought we'd see the best quarter for stocks in 22 years? And then you see over to the right again, we had declining interest rates still, with all that Brian was talking about, and bonds are up 3% in the U.S. and global bonds up about 1 3/4. So again, it was a very volatile. Things were moving very fast, and so let's get into something maybe a little less volatile and talk about the election.
All right, yeah. As if we don't have enough issues to deal with, we've got November 3rd right around the, coming around the bend, and elections can be unpredictable, to say the least. I'm not sure what the deal is with the Bugs Bunny thing there, but where'd you get that, Dennis?
I had to get something funny about an election, so.
Exactly, because I think one thing that we can count on with this election anyway, it's just now heating up, and I think there's gonna be plenty of mudslinging and plenty of, from a financial standpoint, plenty of people are going to be saying, well, here's what you need to do if so-and-so gets elected or so-and-so loses. So that brings up the question, should long-term investors, or should any investor with a long-term investment strategy change their investment strategy based on the outcome of an election A and the result in the markets of the outcome of an election B? And so, as we always do, we want to look back at the data, lots and lots of data, to try to bring some, solid perspective to the question. And as we do this, I think, you're going to hear it's a broken record, but a lot of people are saying, well, the economy is horrible. How could stocks, do well? I mean, and this all goes back to the issue of markets are very forward looking. But the point I'm trying to make about the election is that markets quickly incorporate, because again, it's millions of investors investing literally billions of dollars every day in publicly traded securities. And these are very smart, let's call it what it is, some of them very greedy people on the buy and the sell side of every stock and bond trade around the world. So they're gathering all the information they can, and it gets embedded into securities prices instantly. So if you're thinking about changing your long-term investment strategy based on some short-term event, i.e. the November 3rd election, I think it's important to ask yourself, who else doesn't already know what you know? And therefore, why wouldn't that already be in the price now? With that said, elections can be kind of surprising, and things can happen. But even if you guess the winner of the election, does that necessarily mean that you have, altered your investment strategy to profit from it? And maybe not. Yeah, and Dennis, I mean, we need only look back at the last election to kind of, look at some of these points that I'm trying to make.
Sure.
I mean, you guys remember this, Hillary and Donald were in that was pretty ugly and pretty entertaining. And, not to state the obvious here, but Donald Trump was not, when in most polls, was not predicted to win. And before I even get into any of this further, we're not taking sides politically, one way or the other. I know that a lot of people have a lot of very strong feelings about it, and everyone's entitled to those feelings. That's not our job really, though. We're financial advisors, and I just want you to think about, the facts and how they really play out, and whether you ought to be making major overhauls to your long-term strategy based on this upcoming election. But going back to, September and October of 16, here's, Trump would cost the U.S. economy more than $1 trillion. Stocks would fall 8% if Trump wins. And remember, looking back at the polls coming into Election Day in 2016, let's just suffice it to say that Trump was not a sure winner. But we woke up the day after the election. He did, in fact, win the presidency. And the day after that happened, markets incorporate that information, and the markets were up, I think, 1.1% the day after Donald Trump was elected, even though a lot of, arguably very smart economic and financial people were saying it's going to be a disaster. And if we look at really what played out, Dennis, if you can go to that next, I think it's a,
there we go.
There you go. I mean, we were seeing all these crazy, scary headlines and trying to pay attention to that. But we also kept, as long-term evidence-based investors with a fiduciary duty to you guys as our clients, we're focused on the evidence. We're focused on what usually happens and what is the highest probability of success. And we're the first to admit that this election is looking like it's anything but an average election year. Nonetheless, in 2016, we ignored the rhetoric. We looked at the data. We stuck to our strategy. In spite of what everybody was talking about, at least the U.S. market ended up, over 11%. We captured that return for clients. And I think that's our job. So, that's what we plan on continuing to do, is focus on the evidence and allocate assets in your portfolio in accordance with the evidence that has the highest probability of us being able to achieve a successful investment experience for you guys.
Right. This is pretty interesting. Brian's talking about the polls and things like that here. So everyone seems to focus on polls. And 4 years ago, we saw that they're not quite as accurate as they claim to be, of course. So what you're looking at here, what this data shows is, as we approach November, really Biden and Trump should be watching the stock market instead of the polls. And here's why. It's, excuse me. Historically, the market performance in the 3 months leading up to the presidential election has correctly predicted election results 87% of the time. So this just shows you since 1928, there have been 23 presidential elections, and 14 of those times, the S&P 500 moved higher during those 3 months preceding election day. So in 12 of those 14 instances, the incumbent party won the presidency. And on the slide, all the green checks are when it worked, and the red X's are when it did not. So 12 of the 14 times.
Dennis, I'm sorry to interrupt. All the green checks are when it
was correct.
When it accurately predicted who took the White House.
That's right. Yep.
All right.
That's correct. So again, in 12 of those 14 times that the S&P 500 moved higher, the incumbent party won. And on the flip side, when you look at this, there was 9 times the S&P 500 declined over that 3-month period, and the incumbent party lost 8 out of those 9 times. And so if you think about it, this really makes sense. I mean, it's, in the rising times, you've got rising consumer confidence and rising 401k balances and, likely low unemployment, things like that. People tend to vote based on their wallet. So they want to keep that going. And on the flip side, if those things are not working out, then, they want to change. So, let's say, if that works, we can predict who's going to win this with 87% accuracy. What can we do with that? And so we look at, here's the returns at that same time. This is the past 23 presidential terms over an 80-year time frame, and just look at this and see, is there a pattern that we can, use this information and exploit that and make any, investment decisions on. And what we see is no. The only thing I see here is the odds are in your favor of positive returns regardless of the party. And you think about it, in each of these elections, there was uncertainty. There were concerns about what's going to happen to the economy or and the stock market if this party's elected over that party, or or this person over that person. And each time there's volatility before and after the election. But when the election's over, we know who's won. Markets tend to like certainty, and then we see positive returns the large majority of the time. So we don't know where that's going to hold true this election cycle, but if the future is anything like the past, this just shows us we should remain invested. Again, so this is the same time frame again, just showing, if you invested $1 at the beginning of that in the S&P 500, you've got a little over $10,000 now. If you just stuck through all these Republicans and Democrats in good times and bad times and wars and peace times and high oil and low oil and all these things. And so I know some of you are looking at this right now going, that's great and all, but I don't have 80 years. So that really doesn't matter to me. And so, so let's take it down to the past 10 years. And so this time frame covers both Trump and Obama in this 10-year time frame. And I think everyone watching this could agree we probably don't have two presidents who are more different, right? And so if you look at this, the average return in the last 10 years is 11.7%. And think about this, in this 10-year time frame, the beginning of this, we had tax increases. Towards the end, we had tax decreases. We had multiple regulation changes in different sectors and different businesses. And in spite of all this, and even in this 10-year period, the employees of the 14,000 companies across the globe that you're invested in woke up every day and went to work. And they wanted to improve their company profits. They want to increase their pay. They want to provide a better life for their family. They don't care who the president is. They're going to get up and do that every day. And, I would expect that won't change going forward. And I guess let me add this too before we move on to this. So here's what we're saying though, of course. So this, stick with the plan, stay invested. But, if things like this, all these things we're going through are causing you not to sleep at night, or you've got, if you're having family issues because of it, or it's really wearing you down. I mean, you don't have to be, stick with, exactly your plan or go to all the cash or something. I mean, maybe we can make some adjustments if we come in and look at your plan and, okay, guys, I can't take this anymore. What if I backed off a little bit? And we can run that through your plan and look at, okay, what happens if we do that? How does that change your plan? How does that change your cash flow, or, if any? And then we can look at, maybe we can back off some of the risk or something like that. So, we're not saying don't call us and talk to us about it. Definitely give us a call. I mean, we're always here, of course, but we're just kind of showing you what we see and, why we wouldn't make any changes otherwise.
Yeah, I mean, I might just add, I mean, we never forget that it is, this is your money that we're talking about. But and I know a lot of people have a lot of very strong feelings and strong emotions about this issue of the election coming up. But, the bottom line, or the fact of the matter, I think, is that the capital markets don't, fear or hate, one candidate or the other. What the capital markets hate is uncertainty. And on November 3rd, or I guess depending on how many votes come in by mail shortly thereafter, this uncertainty of who's going to be the president of the United States of America is going to get resolved, and the market will get the clarity that it so craves. And that's typically a good thing. Right. In financial markets. Even if your candidate loses, that's typically a good thing for financial markets. But again, it's your money. As Dennis said, if this is causing you to not sleep at night, or strife in the family, or whatever, we're not saying, hey, don't call us, just stick to your strategy. I mean, that's what we're here for. We're your advisor. Get us on the phone. Get in to see us. or let's do a go-to meeting like this.
Yeah.
Really, yeah, you want to do one of these kind of meetings, a personal meeting, and really talk about your situation and what you're thinking, and maybe what your husband and wife are thinking, and and come up with, there is a logical strategy that will get you a solid rate of return, I think, that'll still allow you to achieve your cash flow goals and objectives while minimizing your risk, your cost, and your tax. And it may not be your standing asset allocation. It may be, but changing your long-term strategy, based on something that's coming up that's going to be short-term, like this election, it's not a decision to be entered into lightly. It can have very significant consequences, and therefore a lot of forethought ought to go into it. And we'd like to, to the extent that you want us to, help you think that through and develop the right plan for you and your family. So the strategy going forward, it's the strategy that we have been working on improving. The team showing up every day, executing the plan according to clients' goals and objectives. And it isn't just the Brian and Dennis show, by the way. This strategy is based on decades and decades of peer-reviewed academic research coming out of the leading business schools around the world, a lot of it Nobel Prize-winning academic research. This is, pretty much what the leading pension plans of the world do with their asset allocation or investing decisions. And we try to bring that to you at a personal level. All of that, Dennis, I hate to go back again, but I want to do it. If you have not lately reviewed our investment philosophy brochure, this is the playbook that we're using. It's nice and pretty and all that kind of stuff, but this is the playbook that we're using when we when we show up every day to work to manage your hard-earned money. So and the most important, so we'd encourage you to go to our website, pull it down, review it. I think it does a pretty good job of explaining the strategy in plain English. I think we just got a bunch of them printed up. So we got a bunch of hard copies. You just call the office at 405-607-4820. Happy to get you hot off the press, recently revised copy of our investment philosophy brochure, which documents the strategy. But the most important thing about an investment strategy is you actually have one. It's amazing, really, but really, I'm in this, it's 28, I think I've been doing this like 28 and a half years. And when we meet with someone for the first time, it's amazing to me how few people have an investment strategy, and how, even fewer have it documented. But the most important thing about an investment strategy is having one that you can stick through good and bad times. And it's easy to follow an investment strategy when things are going up, right? How hard is that? This is great. Why would I change it? It's hard. It is hard to stick to a strategy when things are tough, when nothing but bad news is out there, when, maybe you're just back to break even in your portfolio and you're going, come on, man. This is the most important time to stick to your strategy, and to understand what your strategy is, and to understand what you own and why you own it, and how it's likely to work to help you achieve your goals and your cash flow needs and objectives. So I think it's real important maybe to take a look at that document if you have. Some people have a little bit extra time and all this lockdown stuff. So
it won't take you too long to go through it.
Yeah, it won't. I think that was, what this results in is a portfolio that's globally diversified. We don't have just 50 companies or, these select 25 companies. It's diversified across more than 14,000 stocks and bonds of companies and governments around the world. And importantly, the reason that we do that, results matter. And so the next picture, Dennis, if you'll pull it up, is the results of this strategy, this global strategy that we implement. And what this is, it's a dollar invested in three places. You could have it in T-bills or sitting in the bank. And a dollar going back to 1970, or the past 50 years, Grudy will be worth $9.45.
Not much.
$1 invested in some of the largest blue chip companies in America grew to be worth $16.
16.
Not too shabby. I mean, 100-fold. But $1 invested in the global strategy that we run for clients, at least in the stock sleeve of your portfolio, grew to be worth over $400. So it's pretty simple. You'd rather have 400, follow a strategy that produces 400 or 100. T-bills are a non-starter, particularly today, since they pay like .02 or something.
Might not get 9 anymore.
But that's really kind of the why behind. To close this discussion, I'm going to ask you for your indulgence, because I see the people that are on the call, and I know well that this is not your first rodeo, and it's not ours either. You know, we've all been through a lot of and we find ourselves today with this coronavirus situation in a very tough time, one of the tougher times that I can remember. But we tend to forget, particularly when we're going through today's, apocalypse, for lack of a better word, we tend to forget how much we've been through over the years. So I just want to kind of walk you through, going back over the past 30 years, back in 1987, there was Black Monday, when stocks on one Monday went down like 25 or 30% in one day. Can you imagine? And then we're in a Gulf War, and like today, we are in a recession for 2 years back in 1990. We fight too much, and today, we have rioting in the streets over all this Black Lives Matter, and but remember the Rodney King thing back in Los Angeles. We've seen this before, and it created a lot of turmoil, and it's sad to see people fight and riot. And I hope it goes away quick, but it's happened before. No one's going to forget the fact that the World Trade Center was bombed for the first time during this block of uncertainty. The government shut down twice. And anyone who has any, connection to Oklahoma, never going to forget the Oklahoma City bombing.
Right.
So hopefully things will get better and more peaceful and certain, right? Well, here we got the Asian financial crisis, President Clinton, impeachment. Remember the Y2K thing? I can remember like people would call up, planes are going to be falling out of the sky, and all the computers are going to go to zero, and we're going to get our 401k statement and it'll have zero, and all the computers turning the clock to zero is going to end the world. Well, the world didn't end. In fact, a lot of people at that time were buying into the whole new economy and the technology boom that was happening in, 91 and 92 and 93 and 94 and 95 and 96 and 97 and 98 and 99. And then March of 2000, people that drank that Kool-Aid that any company that had a .com on the end of its name was going to make them money, the next morning at 9 o'clock.
Right.
The NASDAQ went down, I think that year, about 85%. And I had a lot of people say, well, why don't we put all our money in the Munder net fund, net fund, it's up 90%. My neighbor said so. Forget all this boring academic stuff. So we had a recession again, and then we're in war with Afghanistan. So hopefully things will get better. But then the next block of time down here, we go to war with Iraq. And, here comes some epidemics, the avian flu, SARS epidemic. Katrina was a tough situation, still is, for the people that live in New Orleans and the Gulf Coast of the United States. So hopefully things will get better, but then we had the whole financial crisis and the mortgage crisis and Lehman and, the great financial crisis. No one's ever going to forget 08. And a lot of people have said to me a million times, I don't ever want to go through an 08 again. Well, I'm starting to think I don't ever want to go through a coronavirus again.
Right.
But in any event, the U.S. debt during that period of time was downgraded, and it never happened. And people were talking about the end of America. We've had a couple of people talk about the end of America. I mean, this is not the end of America. We're going to make it through this situation. The government shut down during it. So then it'll get better. But here's another epidemic, Ebola. I don't really remember, honestly, what all the facts were surrounding the taper tantrum, but that was a big deal back in, and it created a lot of volatility in the markets. Oil crisis, we're still going through tough days in the oil patch, as everyone on the line is well aware of. The Zika virus epidemic, Brexit, that's still going on. The U.S.-China trade war, we're not finished with that, and here we are in the, right in the middle of this coronavirus. But if you look at the trajectory of the capital market, again, this is the S&P going back to '87, you see that $10,000 invested in the U.S. Large cap stock market grew to be worth what it looks to me like about $160,000.
Yeah, or more. Yeah.
Or more. I mean, so the advance is permanent. The advance will continue to be permanent if the historical record's any guide, and it's one of the only guides that we have. And the declines are temporary. The declines are painful sometimes, yes, but they're temporary. And we just went through the fastest bear market that we've ever seen, and we've just seen we're in the middle, perhaps, of another bull market. I mean, I don't think that I hope that it's evident that we are. Let's just call it maybe cautiously optimistic, but I think this is going to be a long slog and a long road. We're up for that challenge, but we still cannot rule out, maybe the coronavirus decline in the markets was a blip and you're just going to miss a big uptrend for a lot of reasons. I mean, I don't know, but I do know that, we get a good vaccine and good treatment, and people are eager to get back to work and live their lives and go on vacation and go out to dinner and all that kind of stuff. And with what'd you say, Dennis? $5 trillion in
Correct.
money market earning zero.
That's right.
This thing could turn around pretty quick. I'm not saying that that's the way it, and I hope I don't come across as a Pollyanna. What I'm really trying to point out here is that we've been through tough times before, and we can either, kind of suck our thumbs and wish it wasn't so, or we can play the ball where it lies and get tough and do the best job we can and go on the field every day and run the strategy. And that's exactly what we intend to do. So
That's right.
Our job is to make the most of your hard-earned money, and we plan on continuing to do that.
Yep, that's right. I think that slide can be summed up with, it's always something.
It's always something. Yeah.
So we've talked a lot here about short-term volatility and declines in stocks, and this has always been part of investing in stocks. It will continue to happen going forward. Sometimes it'll be quick and painful like this year. Sometimes it'll be slow and a little less painful like 2018. But it's important to know, we plan on this happening. We know it will happen. We just we don't know when. And this is the whole reason we have bonds in your portfolio. And especially for those of you taking income, it just buys at that time and keeps you from being forced to sell stocks when they're down. So, bonds are like your portfolio insurance. And this chart's a great example why. The red line shows you years that the stocks were down, and the green line next to it is what bonds did the same year. And so as you see, the overwhelming majority of the time, bonds had positive returns in years where stocks were down. And so owning bonds really provides three very important benefits to your portfolio. And first, of course, is it keeps your portfolio from declining as much in down markets. And second is, as I mentioned before, for those of you taking income or will start taking income soon, or need some for a purchase we've discussed, it buys you time. We always have about 6 months to a year in cash. On average, I'd say most of you have at least another 5 to 7 years of income needs in bonds. Many of you much more than that, 10 plus years. And so this allows us, and more importantly, you, to focus on where stocks will be 6 years from now and 7 years from now, and 10 plus years down the road, not where they are in November 2020. Because we don't need them in 2020 in November of 2020. We're going to need them maybe 7 years down the road or 10 years down the road, possibly. And third, it gives us dry powder to use for rebalancing. When stocks are down, we can sell a portion of these bonds and book those gains. And then we use that money to go buy stocks when they're down 20, 30% and help you actually benefit from these, short-term declines in the stock market. So this chart's a great example of that. It shows you the S&P 500 here in the middle, and on the right column is long-term government bonds since the year 2000. So the years highlighted in green are years where we saw large declines in stocks. And as you can see on the right, the long-term bonds did a great great job of hedging these declines. And so most of you, probably 99% of you out there have these in your portfolio. If you look at your holdings, it's the Vanguard Long-Term Government Bond Index. And then if you look at the bottom here for a more recent example, in the first quarter of this year, when stocks were down almost 20%, these long-term bonds rose 21.5%. So they did their job, they did it well. And again, that's the reason we have that position in the portfolio. Let's get on to the next one here. So I just mentioned rebalancing a few slides ago. And remember, we monitor your portfolio every single day for rebalancing opportunities. We've got 3 traders. I don't know how they. Yeah.
Well, not on Saturdays and Sundays.
Okay.
Every day the market's open.
Monday through Friday, unless it's a market holiday. Good point. So but we've got these 3 traders sitting there doing nothing but monitoring your accounts using our portfolio management system and looking for rebalancing opportunities. And so this slide's a great example of why we monitor them daily, not quarterly or semi-annually or anything like that. It's because they move fast. And this is also really a great example of why we don't market time, trying to get in and out of the market. So what you see here is the 20 worst trading days on the left side, the 20 best trading days on the right side over the past 20 years. So what you'll notice, I need to get to my pointer here instead of the pen. Hold on one second.
I was wondering what happened to that. You're getting pretty good at that.
So the worst trading day over the past 20 years was March 16th of this year. So I think we can all remember that day, that one of the many that wasn't fun.
That was a long day.
Yeah, one of the many long days this year. So the very next day, one of the 20 best trading days of the year. The day before, or the week before, I'm sorry, the second worst trading day in the past 20 years, yet the very next day, one of the top 5 best trading days we've seen in 20 years. Now we saw it again the week before, then the very next day, one of the top 20 best trading days. And then we saw it 3 more times in 2008. So you look at this as the majority of the best and worst trading days just within those 2 recessions. So, what are we doing? What did we do, I guess I'll say, this year? I talked about rebalancing, with these extreme market changes taking place. I just want to take you through a quick example of it. So I know, all of you have seen more trade confirms and more trading on your statements than this year than you've probably seen in quite a while, especially if you haven't been with us, if you weren't with us in 2008. So, again, quite a bit more than the last few years. It's because of the market volatility. And so I want to get my pen back here. So most of you started seeing some trades. This is about, March 6th through the 12th, this area right here. And what we're doing is, as we monitor it, these bonds, our long-term bonds are up about 20%. Stocks were down close to 30%. And so your allocation was off. And so what we did is we went and booked these gains right here and then took that and went and bought stocks down here down 25 or 30%. Not the whole portion, just what we're over allocated in. If you were 60-40, we're putting you back in your 60-40 mix and booking those gains in the bonds. And so what you'll notice from that point, again, we talked about that second quarter, is we saw stocks quickly rebound.
Dennis, can you go back to that first trade? Because that did affect a lot of people, probably everybody on the call. So obviously, one of the primary goals, if not the goal of investing, is to buy low and sell high. So you'll notice what Dennis is explaining is that we have these long-term bonds and they performed, better than their long-term average. Perhaps we could just say they performed better than expected, up, 20, 25% this year. And so we went in and we sold high, and then we took those proceeds and we went down and we bought shares in some of the better companies around the world, buying low.
Yep. And not because we knew they were coming up immediately. It's just we're rebalancing based on, keeping you within your asset allocation. And yeah, we know they will eventually. We just don't know how fast. And as we see here, it happened, much faster than expected. But yeah, so some of you saw, again, we look at each individual portfolio. So there were some trades in here as well. I mean, there's some more volatility in this point. So quite a few of you saw some more trades in between. But then we saw another, where the majority, if not all clients saw quite a few trades in here, because what's happened is they were down 30% here. They're down about 5%. So we did the opposite. We went and took those gains now that we made from the stocks, and we went and put them back in your bonds, which you look and they were pretty much, maybe a little down or about flat over that time. And so, again, we bought these bonds, some of your core bonds, things like that. And for those of you taking income, we just bought you more time again with that. We have more time to where we're not forced to sell stocks. And so when you see these trades go through, the volatility is uncomfortable, but we're taking advantage of it, and we're making sure we keep you in, within your risk level, and just take advantage of these quick market declines, and try to help you out as much as we can with it. So that's, Brian, you have anything else to add there?
No, I mean, all this is just, this is a tough time. Can't tell you how much we appreciate y'all's. It takes a lot of faith, I know, and a lot of trust in us and our team. And I just, hope this time that we spent together has been helpful, and maybe evidences the fact that we're paying attention, and that we're, doing everything that we can to make the most of the situation. It's a tough situation. It's not over, and it may be a long, hard, road, but it's our job to help you get the return, a solid return that will help you achieve your goals and objectives while minimizing your risk, cost, and tax. And we commit to doing everything we can to help you make the most of your hard-earned money. I don't have much else to add about that. Why don't we, so we're going to go into, I think we're at about an hour now. We're going to go into Q&A. Anyone that needs to do something else, we totally understand. We're not going to be offended if you need to do something else. Dennis, you want to, first question.
I'm trying to read it here to see if we can shorten it.
I think the question really relates to, what can we do if we have a strategy that is focused on dividends, and if we see a prolonged weak consumer economy and companies slash dividends, and that is going on, right. Then what happens to clients whose portfolio depends on dividend income? That's a tough spot.
Yeah,
that is not the spot that any of our clients find themselves in with an aligned portfolio, however. But here's the trouble with fixed income. There's no income. Here's the trouble with dividends. Dividends compete, with fixed income. And if interest rates are at zero, why are companies going to pay out dividends other than that they don't have any good ideas for reinvesting that money? So all of modern portfolio theory, and let me sort of, well, I'll get to this in a minute. All of current modern portfolio theory basically takes a total return approach, right, not a dividend only focused approach. And it's for this very reason that a lot of times you don't know where your returns are going to come from. As a shareholder, you can make returns in the form of dividends. You can make returns in the form of capital gains. Management of company may have new ideas for new markets they want to enter, or new business opportunities where they think that they can do better with that cash than paying it out in dividends. And here's sort of the again, to try to dumb down this fancy word called modern portfolio theory, here's the gist of it. So modern portfolio theory recognizes that dividends are a good thing and dividends are nice, but that, let's say that you've got a barrel and you want the barrel to keep the water level at 8%. I'm just making this up, okay, so indulge me. So you want the barrel to keep the water level at 8% no matter what happens. Now, do you care as long as the barrel stays at the level you desire of 8%? I mean, do you really care whether the level stays there because of rain or sleet or snow? Neither
No.
do we, because neither do capital markets. But I think that if one is 100% dependent on dividends, one may want to take a second look at that. It's kind of like the other day, a guy told me, do you know why Rottweilers don't chase their tail? It's because they have no tail. You know, if companies don't have to compete for interest on bonds and CDs, and they'd rather keep that money and redeploy it, you know, to new business opportunities,
they're going to do it.
They may do that, and you may see dividends continue to shrink. So I don't know if that's a good answer or the answer you wanted to hear, but that's.
And I might add that, you know, just using this example I just went over on kind of how we do it, and you know, a lot of our clients, we've gone over this with you, but you know, let's say a client's taken out. I'm going to try to use my drawing. That's pretty good. 5 seconds of myself. So if they're withdrawing $50,000 a year, and we've got that set aside. So again, we're not depending on you know, dividends for their income. We've got maybe, you know, I'm going to say anywhere depending on their asset allocation, 40 to 60,000 or something like that set aside. You know, 30 to 60, let's say. And then as they're withdrawing money, and let's say when we did this rebalance and they're down to 20,000, when we do this rebalance, let's say we take a gain and we've got, you know, I'm just making up numbers here, 60,000 that we need to deploy, and I just said we put that all back in stocks. What we look at first is, wait a minute, we've got this, their kind of war chest over here, that their income we need. We just made $60,000 on these bonds. We're gonna put 30 back in this and fill it back up, and we're gonna put 30 back in these stocks, and now we're back at 50. And so, yeah, like Brian said, we don't care where it's coming from. The stocks are paying dividends, we're getting income, but we're getting gains. And when we get those gains, we book them and replenish this and make sure we keep them. So that's, you know, that's how we look at it a little bit different. We don't have to worry about, you know, the dividends on each of the stocks on it. Good question though. What else? Anyone got another question? That's really the only one we've got here.
Anyone else? Anyone else, please? All right.
We could have done that. Well, good.
Listen, yeah. you guys have stuck with us through an hour and 7 minutes. We really appreciate it. You know, I hope that this has been helpful. Please go back and take a look at the investment strategy brochure if you have the time, or call our office and have us send it to you. Or better yet, if you have any questions or comments, or you just want to kick things around, we're always just a phone call or an email away. And I hope you know that. And that's one thing that we try to do, is get back with folks right away. We're always, you know, we always like hearing from you, and we're eager to help. So
thank you, everyone.
That's all we got for today. Thanks for being here.
We appreciate you all.